this earnings week didn't just deliver, it roared. In a macro environment clouded by inflation worries, rising rates, and recession fears, big tech stepped up and delivered a powerful message to the market. The AI revolution is not a future promise, it's happening now. Meta and Microsoft didn't just beat earnings, they blew past Wall Street's expectations. Meta's advertising machine, supercharged by AI-driven targeting, fueled a 22% year-over-year revenue surge. Meanwhile, Microsoft's cloud division, led by its Azure AI services, posted breakout growth that proves AI is becoming a cash flow machine, not just a buzzword. Both companies continue to pour billions into CapEx, not out of desperation, but because they see what's coming next, an AI-first global economy. Dan Ives called it a historical inflection point for tech, while Cathie Wood emphasized that disruptive innovation thrives in uncertainty. These aren't just headlines, they're signals. Signals that, in the face of tightening financial conditions, AI remains the single most powerful investment theme of the decade. But while the spotlight has been on the tech titans, there's a third stock that also reported earnings this week, one that's been overlooked by the crowd, but quietly reinforcing the same bullish thesis. Its earnings reveal a deeper trend investors can't afford to miss. In this video, we're breaking down what Microsoft and Meta's results really mean for the future of AI, and we'll reveal that third under-the-radar company whose numbers could surprise you. Because in a market where conviction matters more than ever, understanding these earnings could be your blueprint to staying ahead of the next AI wave. First on the list is Microsoft Corporation, ticker symbol MSFT, and what a statement they just made. Microsoft's latest earnings report wasn't just strong, it was a masterclass in how to lead during a generational tech shift. The company posted double-digit revenue and income growth for both the quarter and the full fiscal year, driven by an unrelenting focus on AI, cloud, and enterprise transformation. CEO Satya Nadella didn't mince words. He said, "We are building the most comprehensive suite of AI products and tech stack at massive scale." And the numbers back that up. Azure, Microsoft's cloud powerhouse, surged 34% year over year, pushing past $75 billion in annual revenue. It's not just about hosting data anymore. Microsoft is delivering infrastructure optimized for AI at a pace that few, if any, can match. Every Azure region is now AI first, and the rollout of liquid-cooled, high-efficiency data centers shows that Microsoft is scaling its physical capabilities to support the most advanced workloads in the world. But Microsoft isn't stopping at infrastructure. Their AI Copilot products, embedded across Microsoft 365, GitHub, and Dynamics, have exploded in adoption. Over 100 million users are now actively engaged with these tools, and enterprise customers are scaling deployment across entire workforces. This isn't experimental tech, it's mission-critical software, already reshaping workflows at Barclays, Adobe, and UBS. Behind this momentum is a clear signal. AI isn't just a tool for Microsoft, it's a platform shift, and they're at the center of it. Even with capital expenditures topping $24 billion this quarter, CFO Amy Hood emphasized that this spend is directly tied to a $368 billion backlog of contracted cloud business. In other words, demand isn't the issue, scaling fast enough to meet it is. As analysts congratulate Microsoft on one of the most complete quarters in tech history, investors should take note. Microsoft isn't just participating in the AI wave, it's shaping the tide. In a market full of noise, Microsoft stands out as a company executing with clarity, purpose, and undeniable strength. Now let's talk about Meta Platforms Inc., ticker symbol META, because Mark Zuckerberg just sent a powerful message to Wall Street. Meta is all in on AI, and it's working. In Q2, Meta delivered a stunning 22% jump in revenue, reaching over $47.5 billion, and earnings per share surged 59% year over year. The driving force? AI. Meta's AI-powered ad delivery systems are setting new efficiency standards, helping advertisers reach users with pinpoint accuracy while keeping user experience intact. It's a masterstroke of monetization, AI that actually generates cash. But this quarter wasn't just about ad dollars. Zuckerberg doubled down on Meta's AI infrastructure ambitions, raising CapEx guidance to as much as $72 billion for the year. That's not just spending, it's positioning. Meta, is building out its AI data centers, training custom foundation models like Llama 3, and preparing to compete at the deepest layers of the AI stack. In Zuckerberg's words, "We're laying the groundwork to build general intelligence." And here's the kicker. Despite these aggressive investments, Meta's operating margin soared to 43%. The company isn't just spending, it's scaling profitably. Reality Labs continues to lose money, yes, but the core business is funding AI development at a pace and scale few others can match. Analysts are taking notice. Some called Meta's quarter an embarrassment of riches. Others pointed out that Meta is now out-executing even the most optimistic AI bulls. In a macro environment still jittery about inflation and rates, Meta just proved that you can invest aggressively and still outperform. This isn't the same company that spooked investors in 2022. Meta has found its rhythm, and it's dancing to the beat of the AI drum. For long-term investors betting on AI at scale, Meta just made itself impossible to ignore. Now let's turn to the third stock, SoFi Technologies Inc., ticker symbol SOFI, a name that may not be making headlines like Microsoft or Meta, but just delivered one of the most underappreciated earnings beats of the week. In the second quarter of 2025, SoFi posted $858 million in revenue, up 44% year over year, and handily beat both revenue and EPS estimates. But it's what's behind the numbers that matters most. SoFi has been quietly shifting away from interest-sensitive lending to a capital-light, fee-based business model. That pivot is paying off. Today, nearly 40% of its revenue comes from financial services, up from just 2% 5 years ago. And margins in that segment have jumped from 31% to 52% in the last year alone. The company's crypto comeback is also raising eyebrows, this time with a plan to integrate stablecoin services over the next 24 months. With nearly 30% of SoFi members already holding crypto assets, the company is positioning itself at the intersection of fintech, DeFi, and next-gen banking. This move could unlock high-margin, scalable revenue streams that set SoFi apart from both traditional banks and sluggish fintech peers. Yet, SoFi isn't abandoning its roots. Lending remains its most profitable segment, contributing $245 million in Q2 alone. And crucially, its net charge-off rates are improving, signaling a healthier loan book even in a high-rate environment. In a macro climate where interest rates are still elevated and regulatory risks loom large, SoFi is showing it can diversify, adapt, and scale profitably. As Meta and Microsoft dominate the AI narrative, SoFi is quietly building the rails for financial services of the future, crypto-native, fee-driven, and digital-first. For investors seeking exposure to AI, fintech, and digital assets, SoFi's Q2 results suggest one thing. This is not just a rebound, this is the beginning of a new growth phase. In a week defined by noise, these three companies, Microsoft, Meta, and SoFi, cut through with clarity. They didn't just beat expectations, they laid out blueprints for the future. Microsoft is scaling AI across the enterprise. Meta is turning AI into cash flow and CapEx into a competitive moat. And SoFi, it's reinventing financial services with digital-native, crypto-integrated innovation. If you're still questioning whether AI or fintech has staying power in this macro environment, look at the numbers. These aren't speculative dreams anymore, they're executed visions. So the question isn't if these trends matter, it's whether you're positioned for them. Subscribe, like, and stay tuned, because the next wave of opportunity is already here, and we're just getting started.